Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. India's trade deficit widened to $11 billion in October from $10.9 billion in September. The deficit was, however, lower than estimated as a third straight month of decline in exports was offset by a sharper plunge in imports. Bharti Airtel withdraws its bid to purchase Arcom assets after the Committee of Creditors extended the bid submission deadline on the request of Reliance Jio. Airtel terms it extremely unfair and biased. Saudi Aramco's valuations fall short of the Crown Prince's target of $2 trillion. The world's most profitable company will sell 1.5% stake at 30 to 32 riyals per share in the IPO. The winter session of Parliament begins today. The situation in Jammu and Kashmir, economic slowdown, unemployment and the government's plan to bring the citizenship bill may emerge as flashpoints between the opposing and the ruling alliance. Well, let's take a look at the trade setup for the day. A lot of these news may not have a material impact on the markets. What might have an impact is how the global markets are behaving, because frankly, that I think is the only key trigger point. So what the S&P 500 did, or the Nasdaq or the Dow Jones did in Friday's session, and what the Asian screen is doing today is of particular interest. So the US markets, well, not bad, you would have to say. The moves, there was green across the board, which is actually a pretty good sign. And if you actually see at what the Asian screen is doing today, save for the SGX Nifty, the rest of the Asian screen has some positivity to it. However, emerging markets by and large haven't had the best of runs in the recent times, and a lot of people fear that now the emerging market weakness could actually be a lead indicator of sorts. By the way, look at this chart also. If you remember, viewers, last week or the week before last, I had mentioned this chart about how there was this golden cross which might actually lead to an uptick in the emerging market pack. And this clearly shows that since the golden cross has emerged and only strengthened as an indicator, the emerging market pack has actually gone down. So that's why the chart says what buy signal, because it did suggest a buy and usually it works beautifully. This time around it didn't. And that is what people fear, that the emerging market pack having come off so much, what if that weakness percolates into the US markets? Because the last few days we've seen that the US markets moved in a trajectory which is slightly divergent to the key emerging market indices or some of the leading indices as well. So the US chart moves up and the others move off. So that's the problem. The chart will come up on your screen, but it clearly shows how the US markets have done really well and the others quite haven't managed to do that. So will that weakness percolate into the US markets is the question that a few people have begun to ask. That's the chart, and you will see that top line on the yellow line is the US markets and the other two are the emerging market indices, and somehow they haven't done well. Let's see if the US market starts underperforming. Then that could be perilous for Indian markets as well, because the Indian markets too by and large have been doing okay in stark contrast to what the EM pack is doing. The trade setup, the global cues and the banking stocks would largely be the key monitorables, because I think everybody's banking on the rally in the banking stocks to continue. I think in terms of support and resistances, the last week's low of 11,802, which we dipped to before we again moved back, is being seen at a key support. And frankly, flows have stopped to be the lead indicator of sorts, or the support of sorts, because if you look at the last 2 days, there have been negative flows. We had a string of positive days, but the last 2 days have largely been negative, 562 and 1,008 crores yes, on Friday and Thursday, and therefore flows aren't exactly the picture that will save the space. So what to do in a scenario like this? Bank on being stock specific, but there too, it's more a trend is your friend rather than specific news-based flows that are coming in. I have 2 or 3 names which I thought were important. Sterling and Wilson, the stock was down about 20% in Friday's session. The companies clarified that there's no reduction sought in intercompany loan by promoters. Very interesting that the company is saying that, because the announcement did seem to suggest that there is. Let's see if the market buys it. 20% down in Friday's session. Let's see if there is some pull back in the stock. The debt reduction plans of Wockhardt, these are reports that have come in from one of the websites as well. I think that Cipla, Dr. Reddy's, Carlyle and the Hong Kong Fund are in fray for divisions of Wockhardt. This is reports as media reports, but let's see if this brings about some excitement in the stock of Wockhardt or no. And I thought from amongst the brokerage notes that came out today, there's one more Glenmark, one on some other stock, but Balakrishna Industries, which went up about 5%, in Friday's session is important one. Nomura has upgraded the stock post the results to a neutral from a reduce. The price target has been raised to 840 from 668. So material upgrade from Nomura. Even though the price is lower, the street should actually view this change in attitude as from a clutch of brokerages as positive for BKT. Let's see if this one moves in the session today. And as I said, I'll watch out for all the banking names in the session today. Let's see if they continue the uptick. Let's tell you what's lined up on First Word today. Nikunj Johri will first tell us about the interim framework to resolve stress in systemically important financial institutions. Suzlon Energy's lenders may initiate debt recovery proceedings. Vishwanath Nair will join us with that BloombergQuint exclusive. And ArcelorMittal finally has an all clear to buy SR Steels plant. Nikki Mujatani will tell us what it could mean for the domestic industry. And Indians are more conscious of price points than health when buying packaged drinks. Charlene D'Souza will join us with an analysis there. The government has laid down a set of rules for resolution of stress in financial institutions. Remember, resolution has proved to be difficult in cases like Diwan Housing Finance in the absence of a full-fledged law to deal with insolvency of banks and NBFCs. The new rules will act as an interim resolution framework until such time that a law is passed. Nikunj Johri has this report.
The government has announced a framework for resolution of stressed financial service providers, and this resolution process will have to be initiated by an appropriate regulator. The framework would be for stressed, systemically important financial institutions, and this would act in the framework would be in the absence of a full-fledged law that governs the resolution of stressed financial institutions. The Ministry of Corporate Affairs has notified rules for the resolution of stressed financial institutions, and changes have been made under Section 277 of the IB Insolvency and Bankruptcy Code, which empowers the government to provide a resolution framework for stressed financial institutions. According to the changes suggested or the changes made and notified by the government, the resolution process of the financial service provider will have to be initiated by the regulator, and the regulator would appoint an administrator that will act as a resolution professional. The interim moratorium for the resolution will commence on the date of initiation of resolution until the time admission and the resolution process has been rejected or accepted by the adjudicating authority. The provision of moratorium shall not apply to third-party assets of the company that are held by a trust. Lastly, the license or registration of the financial service provider will not be cancelled or rejected till the time the financial service provider or the stressed firm is under the resolution framework.
All right, let's move on to the next story, and that's Suzlon Energy's lenders may initiate a debt recovery proceedings against the wind turbine maker. The creditors, led by SBI, are left with little choice after both bidders withdrew their offer. Vishwanath Nair is here with more on this BloombergQuint exclusive. Vishi, good morning. What do you have for us?
Good morning, Neeraj. So, as you said earlier, that there is a consideration amongst the lenders to Suzlon to initiate some kind of recovery proceedings. Now, these recovery proceedings could either be in the form of a DRT referral, which is a debt recovery tribunal. Essentially, that's where lenders go to if they want to liquidate the company, separately sell their assets to different bidders. Or you could also go through the insolvency route, where there is a liquidation option available directly, rather than going through the whole resolution again. The fear of not finding buyers through insolvency comes because of what has happened in Jet Airways. Now, there again, there were multiple rounds of sale which had failed. Then the company went into insolvency. There again, no real bidder has come up. The benefit with Suzlon for lenders is, or at least what they see, is that the company has about 15 gigawatts worth of wind power assets. It also has an operational and management company which is considered to be one of the world's best in terms of servicing wind turbines that are already operational in the market, as well as a land that they own where they're supposed to set up fresh power plants. So all of that all of those things are assets which can be monetized and through which the bankers can repay themselves. As far as what we understand, SBI has already fully provided for the account. They have about 3,000 odd crore out of the 11,000 crore worth of debt that there is. 3,000 just belongs to SBI. So they've cleared their outstanding. The other lenders are in the process of doing that. Benefit of that is that then whatever hit you take on the recovery, that really doesn't matter because you've already couched yourself against the potential losses. It is a technically written off account for State Bank of India, which means that only recovery proceedings can go from here on. So that is an important point as well. In the past, we've seen Brookfield, which is a Canadian investor, as well as Vestas, which is another wind power company. Both these bidders were interested in the assets. Brookfield had made an offer to lenders, but the lenders said 70% haircut, we don't want this. Vestas had offered to back a one-time repayment offer by Suzlon. There again, the deal fell apart and then Vestas pulled out of the deal. So now things are looking a little precarious as far as Suzlon goes. It's been a company perpetually under restructuring since 2013 when the CDR process happened. Since then, the company has been seeing rapid decline in its ability to service its debt. And earlier this year, it had defaulted on payments to bankers as well as bondholders. So to that effect, now banks are acting and trying to take some recovery mechanisms.
Well, considering how long and how tedious resolution processes are, it'll be interesting to see this one, Vishy, but interesting story. Thanks so much for putting this into perspective.
Thanks.
Yeah, I know from a market perspective, people will say that, hey, how does Suzlon matter? But all of these resolutions, not from the assets perspective, but from the lenders and recovery perspective, very, very important. So, very important story. Do log on to our website at some point of time in the day and try and read more about. Almost all of the pieces that we do on First Word would have some mention or the other on our website. So, do try and read about them. Now, the third piece is on the big decision that came out in Friday. Now, ArcelorMittal is all set to lay hands on SR Steels Hazira plant. The world's largest steelmaker had to weather a series of cases by different claimants and finally got the go-ahead from the Supreme Court on Friday. But this entry changes the dynamics of India's domestic steel industry a wee bit, or maybe quite dramatically. Take a look at why we are trying to say this. Now, if you just look at what ArcelorMittal gets as a result of this, at the Hazira plant, it's got a secured raw material source, 6.8 million ton annum capacity, and a dedicated port. Now remember, to start or to, on a greenfield basis, to start off a 6.8 million ton capacity is a process of at least 3 years, if not more, under current circumstances. ArcelorMittal gets that ready-made, and it's backward integrated, it's got a port around it, and therefore from a logistics perspective as well, Hazira seems to be a really good facility. There is blast furnace, there is a sponge iron facility, there is a smelting reduction unit, and according to a lot of experts that we've spoken to, it's a world-class facility, arguably one of the better ones in the whole of Asia. So ArcelorMittal gets a ready-made world-class facility to start operations when it wants. Now, the product portfolio is split across. I mean, yeah, of course, there would always be some advantages or some strengths that a particular plant will have. In this case, the pellet plant and the hot rolled coil plant are the large capacities, and then there's a string of other smaller ones. I'm guessing, I do not know ArcelorMittal's plants. I don't think too many people other than the Mittals would know, but they would probably stick to the core strengths of this plant because that's a good market as well. And so that's as far as Hazira goes. Now, the question is, when ArcelorMittal is coming in and making this fray, who does it have to compete it, in what geography, and with what kinds of capacities does ArcelorMittal have to compete with at least the biggies, and three biggies, right? You look at JSW Steel, you look at Tata Steel, and you look at SAIL, essentially. Those are the three large players in the country. And just look at the geographical advantage for ArcelorMittal. JSW Steel has large portions of capacities in Karnataka, Maharashtra and Tamil Nadu, which is a total capacity of 18 million ton per annum, and they are of course stated intentions that they want to expand. SAIL has West Bengal, Jharkhand, Chhattisgarh and Odisha, which is the larger capacities that they have, and 16.3 million ton per annum capacity. Moving on to Tata Steel, again Jharkhand and Odisha, largely those are the capacities, and 18.6 million ton per annum. And then therefore, when you look at what SR Steel has, that's in Gujarat, which is a 6.8 million ton capacity. In terms of geography, virtually uncontested. There would be few smaller plants in and around, but the larger behemoths, which ArcelorMittal will arguably look to fancy its chances against or compete against, are not quite present in the geography that it is making the production in, and therefore it gets into not, yes, uncharted waters for itself, but in ways and means wherein the biggies do not come in direct competition immediately, and that should augur as a positive for ArcelorMittal. Now, you got to keep in mind that there are a string of smaller players, some of which have gone kaput as well, the likes of Uttam Galva and others, and therefore the ones that you got to compete against are these. The only thing that you got to keep in mind is compared to what the stance used to be for these players in 2016 versus what it is right now in 2019, these are the recently calculated EBITDA per ton numbers at the end of Q1 FY20 for the three players. SR Steel had its plants shut for some operational reasons in between as well. But Tata Steel's EBITDA per ton, very efficient plant, went up to 13,754. And I'm using the term went off because it was substantial climb to what it did 2 years back. Similarly for JSW Steel, but I dare say similarly for SR Steel as well. It pales in comparison in efficiency to Tata Steel and JSW Steel, but SR Steel's EBITDA per ton in FY17, 2016-17 was way lower, I think in the range of 4,500 or thereabouts, and that too has inched up. So there is benefit that has come in for all the steel makers in the last 2 years. I'm guessing ArcelorMittal would be conscious of that fact that the plant currently that they're acquiring is a far more efficient one. Now the question is, can ArcelorMittal do a geo to the existing steel companies or the industry? I doubt that, but it certainly brings in one more very large competitor in the fray. And we'll talk about this with a very eminent guest who understands this industry very well. Rakesh Arora would be joining us at 9:45 a.m. to talk about this particular entry of ArcelorMittal and the impact that it has on the steel industry. So this is a conversation that you would want to be tuned into to understand how the dynamics of the industry change. This is coming in at 9:45 a.m. today, so do try and stay tuned for that. The last piece on First Word is about the Indians' consciousness for price. Price is back to being king in the Indian packaged and carbonated drinks market. The health-conscious Indians who were slowly moving away from Coca-Cola and Pepsi to maybe juices are moving back to carbonated drinks as well. And pricing is arguably the big determinant. Charlene D'Souza has some details out here. Charlene, I'm surprised because when I look at our office, we don't see that phenomenon. But arguably, when you cast your net wide, people are actually doing that.
Yeah, so as this consumption slowdown continues in the economy, consumers are actually looking for lower price point options or something more value for their money. And this is evident because the cola market or the carbonated drinks market has suddenly witnessed an uptick in consumption, while the juices market has actually declined. And the reason being, see, for a liter of juice you get it for ₹100, but if you go for a liter of Coke, or rather if you for the same amount you get 2 liters of cola. Now the size of the carbonated drinks market in India is around 18,200 crores, and the juices market is 16,600 crores as of 2018. Now in an investor con call, that is after the July-September quarter, Coca-Cola's chairman and chief executive officer James Quincy said that sales in India were growing in double digits. In India
for carbonated markets.
So he spoke about the entire Indian market, and they have Coke, which obviously dominates the market. And he said in India, for example, immediate consumption transactions have grown double digits year to date. And so if we look at the figures also in the quarter, the juices market has declined by 7.2%. That is in the July quarter, July to September quarter, it's declined by 7.2%. While it has gone up in the while carbonated drinks has gone up in the September quarter from 4% for the last 2 years to 7%. And if you look at it on the last 3-year basis, in fact last year it has the juices market has declined from 17.8 in 2017 to 16.5 in 2018, while the carbonated drinks market has gone from 7.3 in 2016. It has gone to over 10% in the last 2 years. Now, Mohit Malhotra, who is the CEO of Dabur, he told his investors after the second quarter's con call that the reason for the slowdown in the juices category is because consumers are down trading and looking for cheaper alternatives. However, Parle Agro, which dominates at lower price points in the juices category, said that the lower price end of juices market it hasn't been impacted from the ongoing consumption slowdown. And Nadia Chauhan, who is a joint managing director and the chief marketing officer of the company, said that the current slowdown has not affected our business and we are not seeing much impact on the drinks category. We today have a healthy mix of low price point units and larger packs.
Okay. So, Charlene, it's very interesting that the Coke CEO, I presume, in the call says that sales are growing double digits, and our analysis seems to suggest or is suggesting that the market for juices is actually degrown.
Yeah, the consumption has fallen. It's not degrown, it's fallen.
Consumption has fallen, yeah.
Consumption has fallen.
The juice consumption is falling and the overall market is rising, which means that the share of carbonated drinks or the market for carbonated drinks is actually growing faster than the entire category.
Yes.
Okay, and you reckon in your conversations that price point is the big thing? Because I think the first set of price points that you mentioned, I don't consume any, so I don't quite know. But the first set of price points seem to suggest that carbonated drinks are at a 50% discount to the juices segment.
Yes. So if you a 1.25 liter of Coke is available for $65, but a liter of juice that is available, like a real Dabur juice, is available for 105, depending on the variant you go for. So because of that, price is playing a very big factor. Also, the 10 rupee price point, the 5, 10, 15, 20, they are playing a crucial role in consumption at this point. So Dabur itself is also launching a slew of products at the rupees 10 price point with real coolers. So because that is a segment that's seeing a lot of traction, and that's a market that is a 6,000 crore market where fruity actually dominates. Fruity and Maaza, in fact, from Coca-Cola dominate at this point in time because they have enough of SKUs at that price point, which Dabur doesn't. Dabur obviously played more at the mass, at the the higher volume end, like 1 liter packs. So even they are now bringing more of these packs down to the consumer because that's where consumption is actually at.
Yeah, just one last question, Charlene. It's very interesting. If indeed people were finding it difficult to buy 5 rupee biscuit packets, they've shown no such discomfort in the carbonated drinks. They're going out and buying them left, right, center from the looks of things.
But you also need to understand that the carbonated drinks is also available at lower price points, right? Not just a liter. If you look at the lower price.
Northwards of 5 rupees for sure.
But if you look at Britannia's numbers, even they've been good, although they play in the premium space, but there is consumption that's happening, even if it comes from newer geographies. It's not like consumption has stopped, but there's been a slowdown in consumption. Yes, consumers are thinking twice about what they buy, but they're looking at more value at the 5, 10 and 15 rupees price points, which make more sense in the rural areas of India.
I guess so. Well, price is the king, likely. Charlene, thanks so much. Very interesting analysis, very interesting story as well. And that's, what's happening in the Indian carbonated space. All of these very pertinent to analyze from an Indian consumption perspective because, frankly, everybody talks about how the consumer-related stocks are the ones that you need to monitor. I must say, from a health perspective, almost everybody that I speak to say that there's no difference between a carbonated drink versus a packet juice. Both of them have similar perils. So try and do your research before you try and take that call. That's all that we have on First Word today, though. Lots more lined up on Indian Open. We get in Mark Matthews of Bank Julius Baer to try and talk about his thoughts on whether this resolution of an IBC case changes that outlook somewhat on India from a foreign investor's perspective. We talk about the second quarter earnings of Info Edge with Hitesh Oberoi, and then talk about ArcelorMittal's entry and how would that change the steel industry dynamics. Rakesh Arora of Go India Advisors would weigh in on that. But after this break, a full tilt towards the day's trade.